Afternoon, ladies and gentlemen. There's been a lot of comments by various financial journalists and other observers of the markets that we're seeing the death of the equity cult. And indeed, Bill Gross from PIMCO was quoted last month as saying equities are dead. So this presentation is going to look at that and see whether global equities are fit for purpose. It's interesting to think about the history of the cult of the equity and when did it first start, and it's generally given to created or first thought by a guy called George Ross Gooby. He was the head of the Imperial Tobacco Pension Fund, and he made a speech in 1956 to the Association of Superannuation and Pension Funds, where he said that equities looked more attractive than for several generations, I think. And that started the cult of pension funds moving into equities. So let's review the history and some of the evidence to see whether they're right, Bill Gross is right, and that equities are dead. Now, if you look at returns from equities over the last few years, they have been pretty dismal. This chart shows the real return from global equities on a rolling 10-year basis. And you can see following the wonderful 80s and 90s, the last few years have been pretty abysmal. In fact, over the last 10 years to 2011, equities in real terms have only given you about a 2% real return, so much less than one would have hoped for. And if you compare those with bonds, it looks absolutely awful. This shows the difference between the rolling return on global equities and the rolling return on global bonds over, again, this 10-year period. And you can see that bonds have massively outperformed equities over the last 10 years. But it isn't just the last 10 years. Global bonds have outperformed equities now over the last 20, the last 30, and the last 40 years. You've got to go back 50 years to find a period when equities have done better than bonds, and that's only by 0.4% per annum. So the historical data really doesn't look particularly helpful. So let's look at the bear case. Is it possible that this will continue? Now, some of this material actually has been looked at this morning by Joshua, so I'll go through it fairly quickly. We believe that we are in a process which we call the Great Global Rebalancing, or the new normal as it was described yesterday. And it's the necessary and slow and painful deleveraging of Western economies and the shift of economic leadership to the developing world. As one of our economists has said it, 5 years in, just another 5 to go then, and indeed it could last even longer than that. As we saw this morning, the financial crisis has led to very high levels of government debt, over 100% of GDP, as we've seen a couple of times today. And history shows that high levels of government debt tend to be associated with low levels of growth. This is a study that looks at different levels of government debt. Below 30%, economies tend to grow quite well. Above 90%, which is where we are today, they tend to grow pretty slowly. So we're in an environment where economic growth, at least in the West, could be pretty pedestrian for the next several years. The other problem could be that actually corporate profits might not grow particularly quickly either. I think this is quite a scary chart. This shows the US economy and what share of the economy is being taken up by profits at the moment after tax. You can see it's at an all-time high. And people who are pessimistic about the outlook say there's only one way that ratio can go, and that's down. The share of profits will fall. So if we're saying that growth is going to be slow and profits are going to fall as a share of GNP, that gives a prediction for growth for profits over the next several years, which is really pretty horrible. Now, I want to explain some jargon. I've heard a bit of it today, and I'm probably teaching Granny to suck eggs to some extent, so bear with me, but there may be some people in the audience who aren't familiar with this particular piece of jargon, and it's what's called the price-earnings ratio. We've heard it mentioned a couple of times today. The price-earnings ratio, or the PE, is the market value of a company divided by its annual profit. So for Apple, for example, which is now the world's largest company, their market cap is about $624 billion. Their profit's about 40. So that PE ratio, the price-earnings ratio, is about 15.5 times. Now, you can do this for companies, but you can also do it for whole markets. You just take the market value, say, of the US or the UK and divide by annual profits of those two markets. And that gives you the PE ratio of the market. And there's something very easy to remember. If it's high, it's expensive, and if it's low, it's cheap. Now, this is a page that we saw this morning. I won't spend very long on it. I think Joshua called it the equity demolition page. I call it the John Cleese-Jennifer Wade ratio. As you probably know, John Cleese got married for the 4th time recently to a lady 31 years younger than himself. And that ratio of the population does appear to have some explanatory force in terms of where the market valuation will go. And as we saw this morning, this is a pretty scary chart because we could be looking at markets where earnings or profit growth is low or non-existent and where the valuation goes down. So this is a pretty pessimistic way of looking at the equity markets. So we get comments like this. This was from a leading strategist. Global equities have underperformed bonds for the last decade. They're not a good hedge against inflation. And anyway, as we move towards defined contribution schemes, at least in the private sector, maybe people won't have the stomach for that volatility. But note when that comment was made, February 2009, about a week before the equity market launched its rally since then, and equities are up 70%. Since the end of February 2009. So not everybody's timing for these comments is particularly successful. Now, we've seen a change in historical asset allocation for pension funds. This shows the local authority pension scheme asset allocation in 2006. And you can see if you add international equities to UK equities, that number in 2006 was about 67%. Today, it's down to about 60%. And if I was to show you the statistics for the private sector, you've seen an even bigger decline in equity holdings, this so-called de-risking of pension funds. Now, when I started thinking about putting this presentation together a couple of weeks ago, I was watching the BBC television news and something came up which I thought was rather interesting. It's a competition which is held every year in a town in Finland called Oulu, and it is the World Air Guitar Championship. Now, I don't know if any of you know what air guitar is, but it's people, generally men, who will be pretending to play the electric guitar, usually to some heavy metal track. Now, I have a confession to make, ladies and gentlemen. When I was a teenager, I used to play air guitar too. And I started thinking about the tracks that I would play if I was to perform in this competition today. And 2 sprung to mind. Now, I was hoping to actually play you samples of these particular tracks this afternoon. I made the mistake, however, of showing my presentation to our legal department, and they started talking about copyright, performing rights societies, all that sort of stuff. So I said, okay, fair enough. Can I show a picture of the sleeve of the album? Oh no, breaching copyright and all that sort of stuff. I actually came up with a new name for our legal department, and those of you who are familiar with the books of Harry Potter will know the characters called the Dementors. And Dementors are characters that suck all the joy out of the world. So I went back a 3rd time and I said, well, could I show my copies of the albums to the audience? And I'm going to do that, and I'm going to see if anybody actually recognizes what these songs are or albums are. Here's the first one. You can tell the name of the group, but can you tell the name of the album? Anybody got this in their record collection? Oh dear, wrong audience. Okay, well, the title of this album is Don't Look Back, and notice when it was issued, August 1978. And the other album that I remembered and thought this would be a great thing to play air guitar along to is one, I won't show this one or ask you for it, it's an album by Journey, and this one is called Look Into the Future. And this was issued in January 1976. And it's if these 2 rock bands from 20, 30, 40 years ago are sending a message to us today about what we should be doing in terms of our investing policy. Both of these bands issued these records during the mid-1970s when the economic and the market situation was terrible. High inflation, dreadful equity returns. But the 10 years after these 2 records were issued, you respectively had 100% return from equities and 200% return from equities. So that's the message for that. Now, what's the bull case for equities? The first thing is actually, despite the fact we've had 2 major recessions in the last 10 years, the last decade hasn't been that bad. OECD real growth has been 22% over that period. Global profits are up over 100%. That's despite the 2 big recessions. The problem is global equities over that period since March 2000, when the markets peaked at the peak of the TMT bubble, have only given you 1.2% per annum. So what went wrong? Valuations. The starting valuations in March 2000 were off the charts. Look at the dividend yields. This shows the dividend yields for the 8 largest markets around the world. They were very low. And in many cases, bond yields were in between 2 and 6 times higher. The situation today is very different. The dividend yields are much, much higher. And bond yields are lower than the equity market yields. And that's the first time we've seen that on a sustainable basis since the mid-1950s, which is when Ross Gooby made his first comment about the attractiveness of equities. So this is a really unusual situation to see. The other point is that if you look at the proportion of profits that companies are paying out in terms of dividends, that's called the payout ratio, it's actually very low, currently running at about 40%. On average, it's being 50 to 55%. So if you are of the view that earnings growth over the next few years is not going to be particularly brilliant, you could still see substantial growth in dividends over the next few years. Now, I showed that chart earlier, which showed profit share in GNP in the US, and it seemed to be well above trend. This is another way of looking at that data, and this looks at the growth in profits over the long term. And this chart shows actually profits aren't that far above trend. And if you are of the view that growth is going to be slow, then the 2 elements which made that profit share of GNP high, which is low wage growth and very low interest rates, are going to stay. So I think that ratio, the high level of profits in GNP, is something that is sustainable looking forward. The other thing, which is, I call this a bit of a myth buster, is that actually there's no relationship between growth and returns. What we've plotted on this chart, on the x-axis we've plotted real growth of a bunch of emerging market economies over the last 20 years. On the y-axis we've plotted the dollar return of those assets over the same period in annualized terms. There is a negative relationship. The best, fastest growing market was China. It's given you the worst return. And Brazil and those other markets which have not grown particularly quickly over the last few years have actually given you the best return. So there is no correlation between growth and returns. The other thing which I think is interesting is we've looked at the US market over the last couple of 100 years, and we've broken it down into periods of deflation and inflation, rising inflation. And this graph breaks that down into those different groups. And actually, low inflation or even modest deflation is the best place to be as far as equity is concerned. So we are at the sweet spot as far as equity returns are concerned. Now, these are our estimates for asset class returns for the various asset classes. I'll say for what it's worth. And you can see that for global equities, we're predicting about a 7.5% return over the next 10 years, quite a bit better for emerging market equities, and I'll come back to that very briefly at the end. But there's a problem. This great global rebalancing thing that I've been talking about, we feel that that will also engender higher levels of volatility, both in economies and markets. And that's a problem. And it's a problem that we heard about, I think, this morning from Strathclyde. Because if you're cash flow positive, more money is coming into the pension fund than's going out, a market decline allows you to buy more shares. I can buy more Glaxo shares at £5 than I can at £6. The problem is if it's the other way around. If cash flow is negative, a market decline forces you to sell more shares to raise the same amount of money. It's kind of like a dividend reinvestment scheme, but in reverse. And that's a real problem. So the solution to this is we should look for strategies which give you low volatility. And there are ways of doing that with equities. The next chart shows returns for 3 types of equities, in blue, orange, and green. The green are the companies that don't pay dividends. And we've shown you the returns over 1, 3, 5, 10, and 30 years. The middle bar, the orange, are companies that pay dividends. And then the blue ones are the companies that grow dividends consistently over time. And guess what? Over every period except the last 3 years, companies that grow their dividends consistently over time have given you better returns. Not only that, but if you look at the volatility, how much do these returns vary from month to month, year to year? You get the lowest volatility from those companies that are consistent dividend growers rather than those companies that keep their dividends flat or don't pay dividends at all. So better returns, lower volatility. That's a good combination. There's one other thing that we believe very, very strongly back at Capital, and that's the power of dividends over returning cash, I should say, to shareholders in other ways, such as share buybacks. This shows the return of the S&P 500 over the last 30 years or so. Its return, on average, per year, 7.7%. Now, if you look at companies that have been significant share buybackers, they've been buyback shares from the market, they've done better, 8.8% over that period. But if you look at those companies that have been consistent dividend growers, they are much better. This, in fact, is a chart that when we have meetings with senior management of companies, we show it to them and say, don't buy back your stock, you do it at the wrong time, always pay back higher dividends. It's better for shareholders in the long run. Now, one thing that's interesting at the moment, again, it was mentioned this morning about the fiscal cliff, and there is a risk that the dividend rate on the tax rate on dividends in the US might go up quite significantly, I think from about 14 to 45%. What we've done here is a little chart that has the tax regime coloured at the bottom of the page. The top line, it might be a bit small at the back. The top line is what happens to the dividend tax rate. The lower is the capital gains tax rate. If it's green, it means it's gone down, which ought to be good, and it's red, it's gone up, which ought to be bad. Now let's look at the returns. The blue bars are dividend-paying companies. The orange bars are non-dividend-paying companies. And you can see that actually it works pretty much everywhere, except one period. And actually you get a counterintuitive result. In a period when the rate of income tax fell, but the capital gains tax went up, non-dividend paying companies did slightly better. So that's kind of counterintuitive. And our work here suggests that there's no relationship between what happens to tax rates in the States and elsewhere and subsequent returns. So it's not going to be derailed by some change in the tax regime in the States. Now I'm going to spend just a few minutes talking about emerging markets. We've heard from lots of people this morning that the fundamentals are much better. They've got lower debt levels. They have big current account surpluses. Again, much of this we've covered. Foreign exchange reserves are much, much higher. There's another thing I don't think that has been mentioned so far, but profitability is higher. They're actually making more on their equity than in developed markets. And another thing is valuations are lower. Now, this is a heat map of the world. It shows where the IMF expects the strongest rates of real growth over the next few years. Red is the strongest, orange the next, and so on. And you can see that the heat map of the world is really concentrated in Africa and Asia, and less so in Eastern Europe and Latin America. But I told you earlier that growth doesn't matter. It's down to valuations. That's the important point. And the next chart tries to illustrate that. Again, I explained the jargon earlier on about PE ratios, price-earnings ratios, ratio between market values and profits. Now you can do ratios between markets. And what I've plotted here is the ratio between the PE ratio of emerging markets and the PE ratio of developed markets. If it's less than 100, that means that emerging markets are cheaper than the developed markets. And you can see at the moment it's running at around 80, so it's 20% cheap. And if you look back over the last few years, that's actually not bad. But you might say, well, hang on a minute. In 2000-2002, the PE ratio of emerging markets was half the level of the developed markets. That's true, but that was the period following the financial crises that we heard about earlier today, the Mexican peso crisis, the Russian crisis, and it was also the peak of the TMT bubble in the developed markets when they were grossly overvalued. So I think that's an unfair comparison. So our view is that these markets look cheap relative to developed markets. And then finally, they are actually generating higher returns. The orange line is the profitability of emerging markets. The blue is for developed markets. And you can see substantially higher profitability. You've got better valuations, you've got better profitability. What's not to like? So, in conclusion, don't look back, look into the future. Hear the message of the pop music of 25, 30 years ago. Future equity returns, therefore, should be much better when we look forward than we look back over the last 10 years. But volatility, unfortunately, will remain high. So try to emphasize strategies where you can get low volatility equities through a dividend-focused approach, and then also look for future growth in the emerging economies. Thank you.
Thank you very much, everyone, for joining and having the perseverance to make it through to the last session. What I'd like to do is answer the same question, which is, are global equities fit for purpose? And some of the themes you will definitely resonate with Martin's presentation. What I'd like to do is, first of all, look at this lost decade that we've been through, this period where global equities were negative in real and nominal terms, and really the period that's prompted this question, which is why bother with global equities at all. Look at current stock market fundamentals to give a sense of forward-looking returns and the implications that we can expect over the medium term, perhaps. And then also look at some growth themes and some learning lessons from the period that we've seen this lost decade to try and give us a sense of perhaps what we can apply within global equity portfolios moving forward over the long term. So how bad was this lost decade, and essentially what drove this period of very poor equity returns? Well, answering the first question, how bad was it? Looking at the left-hand side, it was awful. The left-hand side shows US equity returns over 10 years, annualized, and this is where we have the longest amount of market data. And if you focus on the shaded horizontal area on that left-hand chart and look at that bottom data point, that period is the end of 2009 to the end of 1999 to the end of 2008, and that represents the worst period for US equity returns over the last 110 years. The point next to it is the calendar year decade starting in 2000, ending in 2010. It was the sixth worst period on record for US equities. What I've also done is shade previous lost decades just to give you a sense of how rare these periods are, but also to just bring out the type of events which tend to drive these lost decades. Starting on the far left-hand side, the First World War, moving across the Great Depression, and even during the Great Depression, there was only one 10-year period when US equity returns were negative in real terms. So even during that period, equity returns were better than they have been over this recent period. The 1970s, when we saw a spike in unemployment, but also a spike in inflation. And again, these are nominal returns, so discounted for inflation. And then finally, this most recent period encompassing the crash of the global technology bubble and the global financial crisis. On the right-hand side, I've just stripped out the calendar year decade, and this is the period 2000 to 2010. And even in nominal terms, which is a little bit more complementary, you can see that as a UK equity investor in the FTSE All-Share, your return was still negative 15%. In the MSCI World Global Equities, returns were flat, and that's only because of sterling weakness. I've also shown on there emerging market returns, and I'll come back to why emerging market returns were so strong during that decade, because there are some learning points from the strength that we saw. So what drove the lost decade, and more importantly, do we expect the same type of characteristics to influence equity returns moving forward? The first point that drove this very poor period of return was incredible earnings or profits disappointment and volatility. The chart on screen shows the biggest profit collapses over the last 40 years. And just to explain the chart, the further the line moves down, the bigger the collapse in profits from peak. And the further to the right the chart moves, the greater the number of months that profits were contracting over. And what I've done is highlight the two biggest profit collapses of the last 40 years. And they both occurred within the same decade, the lost decade. And why that matters is because one simple definition of how to value an equity is just to look at its future profits and discount them to today. And therefore, as profits has collapsed, but also as people's expectations about profits in the future in this very disappointing economic environment have also come down, it's had a great influence on stock prices. Now, despite this, profits actually grew over the decade in total. So what else influenced this lost decade? Well, as Martin has said, it was valuation at the beginning of the period. And what I show on the left-hand chart is price to earnings ratios for the developed world in orange and the emerging world in blue. And what I'd ask you to do is just draw a mental line through the end of 2000, which was the peak of the technology bubble. And valuations at that point had reached levels that they hadn't done previously and certainly haven't since. And why was that? It was essentially because we'd been through a period of very strong economic growth, very strong profit growth. We had the advent of the internet, great technological changes. People's expectations were very high about the future. And even more so, people were willing to pay a great deal for equities given their positive expectations. Now, what happened subsequently is that expectations have adjusted greatly. Valuations have taken 12 years to come down to what we think are now very pessimistic levels, but much more realistic levels versus 2000. On the right-hand side, we show correlation analysis, the relationship between how cheaply you buy equities or how expensive you buy equities and your return over a 10-year period. So this is a very long time period, one that as a pension fund, I think you can afford to look over. And what the analysis shows is that there is an incredibly strong relationship between buying equities cheaply, experiencing a strong positive return. On the flip side, if you buy markets when they are expensive, you tend to experience a poor negative return. And that has really impacted performance of global equity markets over the past 10 years. If you look at where markets are today in valuation terms, the implication is we are unlikely to see the same type of devaluation or derating for global equity markets. Our expectation is the next 10 years will be better because the valuation start point is much better. I said I'd come back to emerging markets. The blue line shows price to earnings ratios for our global emerging markets. And as Martin mentioned, in the 90s, there were a number of emerging market crises in LATAM, in Asia, in Russia. And then just as emerging markets started to stabilize, you saw the technology bubble burst, this developed world profits recession. That took emerging market valuations down to levels that they had not been at before. Markets were cheap. And then we saw stability come to emerging markets, and then we saw growth. And going back to that table on the right-hand side, emerging market returns are very much driven by A, how cheaply you buy them, but then B, how much profits grow. And again, that has an implication for portfolios today if you believe that emerging markets are cheap, which we do, and if you believe that profits are likely to grow over the long term, which we also believe. So the final point regarding why this has been such a difficult period is we have seen a phenomenal weight of selling of equity assets over the past 15 years. Figures would suggest that around $2 trillion in the US found their way to money market funds, retail assets essentially around the global financial crisis in 2008. So people sold equity, they sold risk assets, and they moved to cash funds, and they haven't come back. That weight of selling has an impact upon returns. In the same way, if you look at the two charts on the left-hand side, this shows equity and fixed income allocations for pension funds and insurance companies in the UK. On the right-hand side, US pension funds, because of structural reasons, because of regulatory reasons, but also because of the growing level of risk aversity and perhaps changes in preferences as volatility has started to impact people's sentiment towards equities. We have seen a great weight of selling. Now, clearly, you could see more selling of equities going forward, but we would suggest that a large amount of the selling that's happened has already been in the past, and going forward, at the point we're at when valuations are very cheap, you tend to see net buyers come back. It was true at the end of the 70s when the death of equities was last declared. The death of equities has been declared at the beginning of this year. You're seeing companies now buying back their own stock. At some point, valuation has a really strong impact upon returns, and we do expect you will find net buyers, particularly at this point when equities are seriously unloved. So that's obviously a pretty somber picture looking back, but what do current market fundamentals look like? What are the implications moving forward? So our view of current market fundamentals is on screen. The risk warning and the overhang on markets today, the great big macro factors that everyone is talking about are the first two bullet points. I'll touch on each of these points, but we're very aware there's a fiscal crisis. We're not in denial about that. We know that's going to lead to serious levels of volatility for equity investing. That's not going to go away. And we also expect this is going to be a prolonged period of relatively low growth in the developed world. We think it'll be a higher growth picture in the emerging markets, but it's something we're going to have to get used to and invest within. Now, the next 3 points are those that we believe offer an opportunity because we think there's so much skepticism towards them. Companies are profitable despite this anemic growth environment. If you look at balance sheets, they're in a much better place than they were in '08. That has implications for risk and return, and valuations are cheap, and valuation matters a great deal when you think about equity returns over the long term. So first of all, the problems. As you can see, the chart shows fiscal deficit this year, and we're very aware that we're overspending, and that is a developed world problem, and that is having an impact in terms of growth, which is the vertical axis on this chart. What I would point towards is some of those countries on the top right-hand side. If you look at Australia, if you look at Indonesia, if you look at Brazil, these were countries which were deemed uninvestable sometime between 15 and 20 years ago because they had large budget deficits, because essentially there was no growth in those countries. There were serious fiscal problems as well. Time there does tend to act as a healer. Now, in terms of the growth outlook, this is obviously what we're feeling. It's very low growth, below average world, and this is something which is going to stay with us for some time. But when people talk about a low growth world, we would make 2 points. The first of which is, if you look at total global growth, then it's just below the 30-year average. It's actually not that bad. And the reason why is that emerging markets continue to grow at quite a strong level. It's not just the growth, however, it's also the way the world has changed in terms of its composition. If you go back 15 years, emerging markets made up about 20% of global output. Today they make up over a third, and therefore emerging markets are contributing more to the overall level of growth in the world, but growth has been redistributed, and again, that has an implication, we think, for the way the portfolio should be structured. Now, onto the positive news. First of all, we think a low growth outlook is reflected in current market valuations, and that does matter. This chart shows price to earnings ratios, which are the blue bars, and how they compare to the average, which are those orange diamonds, and then the maximum and minimum, which are the orange lines. And what you can see is that today, valuations are somewhere towards the lower end, or certainly below average, versus history. Estimates vary, but what we can say is that a very low to negative growth outlook at an economic level is priced into markets, and virtually a 0 to negative growth outlook is priced in terms of corporate profits moving forward. There's a lot of skepticism being applied to markets. Now, the opportunity, therefore, is if we see the global economy stabilize, and certainly if we see it improve, we would expect valuations to also improve, and that should have a significant impact upon returns. But that tends to be something what we would expect over the medium term. In terms of global earnings, Martin showed this chart on the left-hand side. This is return on equity, one measure of profitability split by emerging markets in blue, developed markets in orange. On the right-hand side, we show consensus earnings growth per year, including the outlook for 2012, 2013. On the left-hand side, we make the point that companies are profitable, free cash flow levels are very high, cost management is very strong. Companies aren't in a bad shape, and they're certainly managing their businesses for a tough economic environment. When you tend to see big collapses in profits, it's because companies are caught by surprise by big changes at the global macroeconomic level. I think it's fair to say we all know that we're in for a tough time, and that is having an impact upon the way that companies are managing their businesses, and that has an impact for profitability. Again, emerging markets there, you can see that in the 90s, although the promise was that emerging market companies would deliver superior profitability, that actually didn't happen until around 2000. Now emerging market companies are more profitable, and again, we think that should be reflected in valuations. We don't think it is today. That's an opportunity. On the right-hand side, focusing on those blue bars in that red oval, per annum, we do expect that earnings will grow over the next 2 years. Currently, valuations are really pricing in a 0 or slightly negative earnings outlook. There's a lot of skepticism. Now, within this, what we care about as a bottom-up investor is whether we can find businesses that we think are growing their earnings, that have durable business models, and particularly that durability will last even in those tough economic times. And from our perspective, we can still find a lot of businesses. So even on a market-wide basis, the outlook isn't too bad. But on a stock-by-stock specific basis, we can find a lot of opportunity. Also, balance sheets are strong. That wasn't the case in 2008. The left-hand chart shows debt to equity. So one measure of how much debt global companies are carrying on their balance sheets. And what you can see is that in 2008, debt levels were high. And that had an implication for risk. In 2008, credit markets, your ability to borrow, refinance debt, they froze. And therefore, there was a broad-based risk that companies would become insolvent because they couldn't pay back their debts. Even Microsoft, with about $30 billion of cash on its balance sheet, couldn't borrow for 30 days. What we've seen since 2008 is overall levels of debt being brought down to much, much more conservative levels. Free cash flow profits have been used to reduce the overall level of debt. Now that is a positive from a risk perspective versus 2008. That has implications for how far some stocks could fall. But also it has an implication for return when you think about the ability of companies, as Martin mentioned, to pay dividends, to increase dividends, and to buy back their stock. On the right-hand side, we show three lines. The orange line shows dividend yields in the US, which are currently above long bond yields. That hasn't happened. Apart from the depths of the financial crisis, except going all the way back to 1950, that does imply either equities are oversold or bonds are overbought or both. On a global basis, you can see that the global dividend yield is 3%. It's a good starting point when you think about return. That blue bar, or that blue line on the right-hand side, is share buybacks for US companies. Companies are buying back about 4% of their outstanding stock because they believe that their stock is oversold, undervalued essentially. Now, if you think in the US, a 2% dividend yield, 4% return potentially from buying back stock, that 6% is a very good start point, particularly versus long bonds. And that's before you believe in perhaps markets revaluing and getting some benefit from valuations or indeed any earnings growth at all. So it's not all bad when you look at the overall level of fundamentals at the market basis. So what are the lessons from the last decade? What do we think you can apply within a portfolio? What are we looking to apply within our own portfolio to help us going forward? The first learning point we think is to stay engaged no matter how hard it gets. The chart on screen shows rolling 12-month returns. And what we've put along the top is a number of market events, negative events, crises, and returns around those points. Now, unforeseen events do happen, and equity markets have always been volatile, but they are increasingly volatile today and will remain so. But the learning outcome from this is that upon those big market events, what you tend to see at the maximum point of pain, the maximum point where it's incredibly hard to go against your natural instinct to take your money and move on, you tend to see markets rally and rally very strongly. And therefore, there are points where you should, despite all of your natural instinct, either be maintaining your portfolio or adding to your portfolio if you're able to, because those periods of relief and those very strong returns after crises are those points that contribute to your very long return as a global equity investor. You have to stay engaged and you have to be contrarian. By being contrarian, that enables you to generate the type of superior returns that we all need over the long term. You don't get paid for being consensus. The second point is a link to valuation, and it's to maintain a broad focus. This is the world cut by sectors, and again, we're showing valuations versus averages and the highs and lows. And what you can see if you look at the consumer staples and utility sectors today is that in this world which is volatile and where risk aversion is rising, you have seen people start to tilt towards areas which are perceived as being very safe, some areas which are perceived as having very high dividends, and seeing those areas as perhaps a solution to this volatile market environment. Now, what we would say is that those areas and stocks which are stable income growers, as well as earnings growers, have a part to play in a portfolio. But we would advocate staying broad in your overall portfolio to make sure you can rebalance to areas which are oversold and to make sure that you can continue to take profit from those areas which are perhaps expensive. And that comes back to that principle that valuation matters a great deal. If in the past it was cheap valuations which drove some of these lower volatile stocks to perform very, very well over the last 10 years, And if those stocks are perhaps more expensive today, then we would certainly advocate, and we do within our portfolio, taking profit, reallocating based on where we can find valuations and good fundamentals elsewhere. A third point, please take the first sentence with a pinch of salt, is we think this environment advocates for global and active investing. And I say take it with a pinch of salt because I sit within a global and active team within T. Rowe Price. But the reason why I say that is because the principle of truly global investing was formed based on, first of all, the ability to go anywhere in the world and find areas which were going to give you above average return, improve your return as an investor. And second of all, to have a cohesive approach to risk, to control risk within a portfolio and diversify. Now, what I've done is put on screen an area which is sort of deliberately contrarian and deliberately controversial, which are our holdings within global financials. Now, some would say global financials, too risky, very, very high volatile and low return. But as a truly global investor, when you look within global financials, there are areas of that opportunity set which have extremely strong return prospects. If you look at the top half, these are some of the emerging market names we can find within global financials. Brazilian malls leverage to some of the very, very best demographics, very, very best consumer trends in the entire world, well-managed, great business. Moving down, banks in Peru, Indonesia, Thailand, Malaysia, the Philippines, economies which restructured a great deal during the 1990s, banking systems which also restructured, and banks which perform a very traditional role. Take deposits, make loans, profitably give you a good return as a shareholder. That's what our developed world banks used to focus on. Now, emerging market banks we see as a good area of opportunity. The other piece here is diversification. Some would say, in a world of risk on, risk off, high correlations, don't diversify, just give me a concentrated portfolio. Don't give me 10 emerging market financials, give me 3. If you ask us to give you 3, it's fair to say it would be hard to get over the hurdle to just invest 4% in any of these names, because there are very stock-specific risks here. Now, in many respects, having that group of emerging market names is no different in active share terms to just holding 3 very large positions in 3 of those names. Our job is to be active. It's also to be thoughtful about risk. In the developed world, some would say within financials, just hold the safest, highest quality names. Now, if you look further down, you can also see that we hold JP Morgan, we hold Standard Chartered. Now, these are the best capitalized banks, some of the most stable banks in their respective industries, but unanticipated events happen in the world, and we continue to live in this volatile world. We think diversification can help with respect to some of the stock-specific risks that we're going to see in the world moving forward. Emerging markets is the final theme I'd like to touch on. I'll move through this very quickly because you've heard a lot about this today. Emerging markets is a growth theme, and it does encompass some of those learning outcomes of the lost decade, which I spoke about. The green line here shows that trend of emerging markets taking share globally. 20% contribution to GDP 10 years ago, now up to 36%. And that's because of growth. Those blue bars show GDP growth in the emerging world. The orange lines show developed world growth. It's been delivered because of growth. Now, what matters to us is whether we are positioned today for the future growth, because the past returns, past growth don't matter. It's all about looking forward. On the left-hand side, it shows one measure of how emerging markets might change in terms of composition within the global universe. The blue bars show the contribution to a global benchmark, the MSCI ACWI index, at 13% today. 10 years ago, that was 3%. So 10 years ago, if you had a 5% weight in emerging markets, you were overweight, you had a good position. Today, 13% is the benchmark, and that's moving up to 19% in all likelihood over the next decade or so, because developed world economies are growing at a very slow rate. Emerging market economies are growing at a much faster rate. One measure of risk, if you look at the right-hand side, again, it's this picture of fiscal stability. Emerging markets had their fiscal crisis in the 90s. They restructured to a very large degree. They reduced debt levels. They also used the good times to pay down debt to leave themselves in a strong position today. The blue line on the right-hand side shows the developed world fiscal issue that we're all very aware of. Emerging market stocks will remain more volatile than developed world stocks, but this is one measure of risk that we don't think is fully appreciated when people think about how much should I allocate to emerging markets today. Just to summarise my learning outcomes, first of all, never show your presentation to legal right at the end. Always keep a version back, Martin. Second of all, we believe that global equities are fit for purpose. And if you share that belief, then to get the best out of global equities, we think you should stay engaged, particularly during the periods of maximum pain. That's when the opportunity is at its highest. That's when you should be countering that natural instinct to sell. And if you can, you should be adding thoughtfully, particularly to areas which at a stock level are durable and persist. The second point is to maintain discipline. We think keep a broad focus in terms of the way you invest. Stick to the timeless principles of diversification. Stick to the principles of buying high-quality businesses, particularly when they're cheap. That goes all the way back to Benjamin Graham in the 1930s, that founding father of investing. You buy companies which are cheap, which are going to survive. That is how you generate meaningful return for investors. And then finally, focus on the long term. We do feel that all of this volatility is really causing a lot of people to focus on the near term. And that's natural. But that does mean there's an inefficiency in our view building up over the long term. And that long-term time horizon isn't necessarily something that everyone can capture. But as a pension fund, having that long duration is an advantage, we think, in this type of world. I've just put a quote there on the end. I don't want to oversimplify, but it's one that was polite enough that I could put on there. But this is a French war analogy, which is something to summarize, which is to buy on the cannons and sell on the trumpets. Thank you.
We've got a little time now for some questions. Have we? Anyone want to jump in? All tired after a long day of engagement with the sponsors. Yep.
Jeff Reader, Bevershire Pension Fund. I was very taken with the chart on the profits. What level of investment are companies doing? Because it sounded as if they're not really investing very much at the moment, and surely that will have an impact for the future.
Are you talking about my chart?
Yeah, it was in your chart, but
Yes.
I think it was referred to in the other presentations that profits were quite high.
Companies are probably not investing as much as they could. I think the outlook is uncertain. Having said that, you are starting to see some signs that it is starting to pick up. I mean, there's an expression that we use internally, which is use it or lose it. And, there is a risk that the US government, which needs a lot of cash, will look at that, profitability and say, maybe we could share in some of that. And I think we are starting to see some signs that investment is starting to pick up in terms of, computer technology, software, even in construction. One of the things I didn't mention, which I think is perhaps a potential upside for the US economy over the next several years, is two cyclical and one structural, which I think will lead to improvement in investment. The first is the housing cycle, where you're seeing housing starts have improved from the lows we saw in sort of 2008, 2009, but they could go a lot higher for a number of reasons, which I won't go into now. And secondly, the auto cycle. We're seeing auto sales at a pretty low level compared to where they should be in terms of replacement, age of the fleet, and so on. So those two areas of the economy, I think, could surprise on the upside over the next couple of years. And far more fundamental is what's happening in terms of the energy complex in the States. I'm sure you've read in the papers about all this stuff about shale gas, the renaissance of the oil industry in the US. Believe it or not, oil production in the US has risen by over 1 million barrels in the last 3 years. They could be energy independent by the end of the decade. And that has profound implications for US industry. So then, as I say, not investing maybe as much as they should, but I can see circumstances where that's going to start growing actually pretty strongly over the next 2 to 3 years.
I just add one point as well, which is I think you're absolutely right. There is definitely a lower level of investment than has been the case historically. That has benefits and costs. The costs, if that reinvestment is productive and is accretive to returns over time, is that you would expect lower returns from equities. But if you look at capital allocation over time, there's a lot of wastage which happens through merger and acquisitions activity, through poor reinvestment because management teams have felt just compelled to keep reinvesting in their businesses, even when there aren't good opportunities. The sort of shift to returning capital to shareholders and buying back stock, that's partly a reaction to this lower growth world. And some of that will be positive, but I agree, some of it will also be negative if companies don't have the same magnitude or volume of profitable reinvestment activities long term.
And I think one of the messages that I got from both of your presentations was the need for active management, active stock selection, as opposed to a more passive buying an index type of approach. And also this issue of trying to think about timing and perhaps some of the difficulties in getting the timing right.
It's, I always say it with a smile because where we sit, obviously we're biased, but if you look at correlations, they really spiked to levels that we'd never seen ever at the beginning of this year. And people were saying correlations at this level means you should buy a passive fund because there's no value to be had from active bottom-up stock picking. What I would say is those peaks tend to be extremes. It's like people saying this is a new normal and therefore you should change the way you invest. Subsequent to that spike, we've seen correlations come down a great deal, and it's been an opportunity-filled year in many respects for a lot of investors. So it tends to be a reaction in some respects to what has happened recently, and it's a very intuitive one, but it's one that I would fight because this world is going to be very dispersed going forward in terms of opportunity, in terms of companies that will survive, some that will not, and in terms of this two-tier world. And that speaks to active management. But it is fair to say that there's been a lot of disappointment from active managers over the past 10 years. So I think we're fighting a battle to essentially maintain trust here. But I would say if we look out, it's definitely one that I would advocate having an active manager rather than a passive going forward.
We don't do passive at Capital, so I would echo those comments. I do think, though, that one of the things that we've seen particularly in the last 2 to 3 years, is extreme reactions to news announcements, be they generally bad. The company comes in with disappointing numbers. And so the kind of contrarian approach of buying something when it falls, you've got to be careful about being too early. And we've certainly suffered from situations where a stock comes out with a bit of bad news. We don't think it fundamentally changes the long-term investment thesis. It falls 20-25%, and then it goes down another 20-25%, and you look a bit of an idiot having bought it at that point. So you do get some pretty extreme reactions. I think the one way of protecting yourself from that is looking at valuations and not to buy those very expensive stocks. Because if a stock which is very, very highly valued, it's got, to use that technical term, a high PE ratio, if it disappoints, then you get what's called a double whammy, because the earnings number comes down and the PE ratio comes down too, so you get hit two ways. So that's something that you should try to avoid.
Okay, any more questions? I think everyone's exhausted or they've accepted the argument so well that they're all going to go off and stand outside your door waiting to sign up for the product. Anyway, can I call on you to thank our two speakers? Well, I hope you've enjoyed today. We've started off with the view from the economist, and then looking at some of the issues that is specific to public sector pension schemes, and then we've kicked off looking at some of the opportunities that may assist us on meeting the liabilities that seem to be growing all the time. That continues tomorrow, so just remind you that the start tomorrow is 8:45 with the sponsors, who are still eager to see you. They've still got lots of information to give to you, so please make yourselves available of those opportunities. Just closing comments really about this room. This is where we're going to have dinner, so please take everything with you. There is the reception at 7:30, which is just outside, and then dinner in here at 8 o'clock. So I look forward to seeing you all later. Thank you.